Hey everyone, happy Friday. Welcome to Finance Friday. This is the show where we give you the information you need to help you grow and protect your wealth. I'm Amy Novakovich. I'm a certified financial planner and a chartered retirement planning counselor. And today, I want you to share this out right away. If I can, I will figure this out because I go back and forth between my business page and my personal page. But share it out because we're going to be talking about something that I've been asked about a lot with mortgages because rates have gotten so high. A regular mortgage now is 30%. So, or 30%. It's not 30%. It's 7%. I was reading 30% here. It's 7% average. So when you're looking at a 30-year mortgage, 7% over time, that's a lot of money. Although in the past that used to be average, but people are so used to the last decade where mortgages were 4 or 5%, maybe some people in the threes and the twos. We're trying to think of creative ways, not that a mortgage is bad, because it still is good, still is a good debt, but just trying to get creative to try to say what other ways do we have to look at getting property or real estate, whether it's rental or a primary residence. I think all of these ways, I actually have 5. I know it said 3 in the description, but I came up with a couple more. There's ways that you can go around a mortgage. Again, not that I'm encouraging that, but sometimes people say we can't get a mortgage for whatever reason. Maybe it's the down payment, maybe it's credit, maybe you just don't want to. Some of my higher net worth clients do not want to because they'd rather do it another way, utilizing leverage in a different way than just getting a traditional mortgage. So let's look at some ways. Again, share this out if you're just joining us. I do have some YouTube videos on our YouTube channel if you want to look there too, little clips on interest rates in general and on leverage in general if you want to check out our YouTube page along with our Facebook page. I have a lot of videos on there too. But today we're just talking about different ways that we can go around a mortgage to get a property. Okay. So one that is super common that most people know, I believe, but I think it's kind of forgotten, is that you can borrow against your employer plan. So if you have a 401k, which is the most common one, you can borrow against the 401k. Now, some employers, it's rare, but some don't allow loans, and that is just up to the employer or the way the plan was built. But most plans do allow a loan on your 401k. What's good and bad? So the good is there's no underwriting. You request a loan. You can even do it online. Like if you log in online, you can request a loan online. You can request that loan. There's no underwriting. You don't have to submit tax returns. You don't have to submit pay stubs. You don't have to submit all this stuff. They will just give you the money. Now, the bad is that the interest rate may be higher than a mortgage. Maybe. Again, depends on the plan, but some are prime +1, so you might be in the 8s. But again, to avoid underwriting and to borrow against yourself, and essentially you're paying interest to yourself, and you get to leave all your investments invested, and now you don't have debt. It's just deducted from your payroll, so it's hard to get behind because it's deducted from your paycheck. So sometimes this is just a better route for people that have quite a bit of balance in their retirement accounts, because that's where most people are putting their money nowadays, is retirement accounts, right? So if you look at the 401k, you see if you can have a loan, that would simply just be a call to HR to see if that would be available to you, and then they would tell you how to go about that. So again, I think most people know that you can borrow against your retirement accounts, but I feel like it's just being forgotten. Again, mortgages have been so low for so long, people are used to just going and getting a mortgage that I just think that some people are forgetting that way. So you can look into that. And if you have more questions on if that's suitable for you, if that's something that you would like to do, because these aren't recommendations. I don't know everybody on here, obviously. So if you want to know if that's something that makes more sense than a mortgage, if you want to compare the pros and the cons, you would call your advisor, you would call your financial planner. So what we would do is we would run it through a plan, and we would run 2 different scenarios to see if that made sense for you. Okay, moving on. Again, if you're just joining, share this out. We're talking about, I have 5 different ways to get creative on getting a property without getting a mortgage. Not that a mortgage is bad, just trying to get creative on other ways, because some routes are more suitable for people than others. Everybody's situation is different. So let's talk about a 1035 exchange. Again, I think most people know about this, that you can actually move proceeds from one property to another property to buy another property, but I I don't think that it's super common like it used to be. Like in 06, 07, 08, 1035 exchanges were super common. And it's starting to come back now because we do have equity in homes now. So we now have prices that are way above what people owe on their homes. So, we can take a look at 1035 exchanges. So what that essentially does is if you have gains on your home, meaning it's worth more than what you paid for it, that's a gain. You would owe taxes if you were to sell that home. Now, in Florida, we have an exemption on some of the capital gains that you don't owe tax on, but above that exemption, you still owe tax. So 1035 exchanges were originally meant to just avoid the tax, the capital gain. So now I am seeing people that are trying to go get financing or a mortgage or a property, and they're like, but I don't know, what if I can't sell my current property? Well, instead of going through all that financing, it may just make sense to move the funds and the sale of your property to the new property. Use those funds, use the funds from the property to fund the new property. So now this does involve usually an attorney. I recommend an attorney anyway to get this done. Again, if you have questions, you can always reach out to us. But this is something that I feel like it's becoming more and more popular now that we have gains back in properties, to use proceeds like that to find a like property. Now, you can't go selling a residential home and using it to buy a commercial property. It has to be a like property, and there's other certain rules about number of days and things of that sort, and the pricing on the new property. But this might be a solution that works for you. So 1035 exchange. All right, and that wasn't one of the original ones in my top 3, so that was one that I kind of added in. So I don't know, maybe it's something that might work for you. All right, number 3, a margin loan. So the reason why I usually encourage people to save in a non-retirement account, so meaning outside of your employer plan or outside of your IRA or outside of your self-employed plan, is because it gives you flexibility to borrow against that later on. This is not a recommendation. I wouldn't just run out and do it because it does have stipulations. So meaning if the market drops, so you can only borrow half of the account. It has to be at 50% of the value of the account. So if the market suddenly drops and now all of a sudden you're borrowing 60% of the account, they're going to do to you what's called a margin call. So you will then have to sell securities to bring the loan back down to being 50%. So again, there's risk in this because nobody wants to sell securities when the market is down, right? So of course this involves risk. So I would usually recommend borrowing less than 50, so you're not, playing with fire there, right, at that 50% requirement. But this is a really nice way. I have a lot of people that do this where they borrow against their own funds. So they don't have to sell stock right away. They don't have to go through underwriting. The funding is done in 2 days. They get the funds and they can do what they want with them. So you can buy a property, you can buy 2 properties, whatever you have saved, and now I don't know how much you have saved, but 50% can limit some people. But this is, again, why I encourage you to save, to build up an account that is worth a lot, that gives you some leverage. So you don't have to go to a bank and get a mortgage. You have the option, at least, of doing what they call a margin loan. Again, not a recommendation if you're just joining or if you shared this out and someone else is now just joining. I'm not sitting here telling you to go get a margin loan. I'm saying it might be an option if you have a non-retirement account where you could borrow against your securities, your investments. And again, no underwriting. Have the money in 2 days and you can go and purchase the property. Actually, some people do it as cash. They put in a cash offer because they have the cash. The person selling doesn't really care where you got the cash. I mean, they don't care if you sold your stock or you borrowed against your stock. Either way, you have the cash. So you can put in a cash offer, and certainly you just need the cash by closing. You have to close with full cash, but it just simply means you're not getting a mortgage. So that might be an option for some of you if you have investments outside of a retirement account. Now, I want to recap real quick. So borrowing against your employer retirement plan, You can do that according to your employer. Sometimes they do have requirements that you can only borrow up to 25% or 50%, but that just depends on the plan. So you just have to make the call to HR. A 1035 exchange is something that you can use to help you avoid capital gains as well as fund the next purchase. And a lot of times that is very popular. And then a margin loan, borrowing against your securities, investment accounts. It doesn't have to be stock. I mentioned stock. It doesn't have to be stock. It could be mutual funds. It could be ETFs. It could be whatever you hold in there, brokered CDs. It doesn't really matter. It's an investment account that's not a retirement account. So it could be a trust account. Could be a joint account. Just, again, something to give you some ideas to start thinking if this might work for you so you can inquire beyond this video. Okay, now, again, two more. I know I said I only had three, but I have two more. So now this one is definitely creative. So private funding. You're technically still getting a loan, but not from a bank. So we have used this actually in estate planning where parent, higher net worth, lends funds to get funds out of their estate to child. It doesn't have to be a parent. Could be an uncle, an aunt, could be a grandparent. Lends funds in the form of just a note, a promissory note. So you create a note, or you could call it a mortgage, but it's private funding. So it's an individual or a couple instead of, or actually even a business. I've seen a business done, but not like you're not going to a bank and getting a traditional mortgage or a mortgage broker and getting a traditional mortgage. This is privately funded. So I actually have clients that are willing to invest in things like this because they feel pretty confident that after vetting the person and seeing what their financials are like and getting a good reference from somewhere, several good references, that they feel comfortable essentially investing that money in that person because they're going to be getting the payments and they're going to be getting the interest rate. So this is something that you could look into. Again, still doing a loan, so you're not really avoiding a mortgage, but you're avoiding a bank. And if you can get it from a family member, not everybody has wealthy family members, but if you can get it from a family member, and it doesn't even have to be an estate planning tool because now the estate limit is super high. But if you can find a family member that would be willing to invest in you, sometimes that is a better and easier route than going through a mortgage because a lot of times banks and a mortgage have a lot of requirements, or sometimes you just can't even get approved as you want it at all. So private funding, or maybe just a piece of it, could be private funding. Again, I have clients that are willing to invest in people to get this interest rate, this income. To them, it's income. So they like investing in real estate, and then they get the collateral of the home. So to them, it really can work out as an investment as long as they feel comfortable that the borrower is going to make those payments. So just again, something to look into. You could ask your advisor if you have an advisor that does have any clients, especially down here. I know not everybody watching this is in Southwest Florida, but in Southwest Florida, we do have a lot of people that would be familiar with private funding. So you could ask your advisor, your accountant. I'm sure that they have resources. We have resources that you can reach out to see if that would be an option. Okay, finally, and I don't even know if this is, this was one that I added, but since home prices went up so much, some people are able to pull the equity out of their home in the form of an equity loan or an equity line of credit. An equity line of credit could actually be just interest-only payments. So for the time being, if you're really just trying to bridge a gap of time, an equity line can be a really good option because it's just kind of like a credit line. No closing costs, no major closing costs. Banks, I mean, it is a bank, but an equity line of credit works differently than just a fixed loan. So it is a line of credit, so as you pay it down, then you could use more of the credit line. And you can pay interest only, and you can pay big chunks of payments, and it doesn't completely mess up, the amortization schedule. So using the equity in your home, if it's just going to sit there, is an idea, but you have to inquire at a bank to use the equity out of your home in the form of either a loan or a line. So they are different because a loan has principal and interest and has fixed payments with an amortization schedule until maturity. An equity line, like I said, is revolving line of credit. But it's just a way that people, again, don't necessarily think, hey, I can use the equity that's just sitting in my home. Instead of going and getting a new mortgage, a new debt, I could use that equity. If I'm keeping this home, I could use it in a way that maybe you didn't think of. So hopefully some of this just generated some ideas versus just going out and getting a traditional mortgage. We have borrowing against your 401k, 1035 exchanges, margin loans, private funding, and using the equity in your home. If you do have any questions, and I'm sure there's other ways, I'm not saying this is all the ways, but this is just, again, just to generate some ideas that we have seen done that allows people to purchase property, that allows people to diversify their investments with real estate, and they are effective. So if that's you and you want to reach out to us and you do want to inquire, we can at least get you with the right connections. Oh, see, there's my notification to share the live. But if you have any questions, comment down below, or you can feel free to go to our website, novawealthmanagement.com, and reach out to us at info@novawealthmanagement. All right, I hope you have a wonderful weekend, and I will see you back here soon. Thanks, guys.